Welcome, everyone, to the Allocation Agenda podcast. I'm Steve McDonald, your host. Today, we have a super interesting conversation with Matt Stiling. Now, Matt, you are the Senior Operational Due Diligence Analyst at Investcorp-Tages. And you've actually got a really interesting background. You've kind of been on both sides of the fence a number of times. You have been involved in a lot of mergers and acquisitions. You've overseen a lot of different teams. And what we're going to talk about today is a trend that we kind of want to take apart and break down and understand, is this idea of the pros and cons of internal versus external investment management teams, and why we should be thinking about both, and why both are important to our overall success. But before we get started, I'd love to just turn it over to you for a minute or so here and just explain a little bit more about your background before we get started.
Sure thing. Thanks, Steve. My career to date so far has pretty much been one of two halves. I mean, the first half, as you alluded to, I've worked across the operational space, kicked off as a hedge fund accountant. I've worked within the operations sphere of asset management firms, led teams doing so, mainly across the fixed income and credit space, which then took me to the next part of my journey in the second half, which was on the ODD side. Started working for an institutional family office, working quite closely with blue chip hedge funds, getting that benchmark for where best practices. And then that took me onto my journey at Investcorp-Tages, where there was very much an emerging manager focus, which has developed. And as I've been with Investcorp-Tages now, the business has grown and is a very different beast to where it was 6 years ago. Investcorp-Tages, or as I said, hands in a few pies, I would say. Our core business is around fund of fund management with a seeding background, where we also host a UCITS platform. And we've more recently added an internal manager platform as well to our business. Investcorp-Tages is a 50-50 JV between Investcorp and Tages Capital, where we took our absolute return businesses, pooled assets. We both have a synergy in the seeding background as well with emerging managers. And then following on from there, we developed the business over that time.
Well, great. So I want to take all that background, which is phenomenal, and ask you a really big question to start out with. And that is, what are the challenges right now that you're seeing in the industry? And I'd love to kind of have you take a look at it from like an industry-wide perspective, and then as an allocator, as an asset manager, like what are the dynamics? What are the challenges that we're facing that are shaping the industry and where it's going today?
Well, I think the biggest challenge across the industry, I would say, is more on the cost base of running an asset management firm. We've seen a lot of regulatory changes over the past decade, all of which have their own embedded costs associated. We've seen talent become more exclusive, more expensive. So those are the two kind of areas I'd probably touch on first of all. I mean, just alluding to the rising regulatory and compliance burden, obviously that pushes up your break-even AUM, especially in Europe. We're seeing a lot of additional regulation that actually requires the onboarding of larger project management style focuses, which again have their own costs associated with those. As I mentioned, I alluded to compliance. I think I'll just touch on that before I go into talent more specifically, but compliance talent is really hard to come by these days. As we've gotten more regulatory change within the industry, we've required people that are more specialized, to the point where actually your typical chief compliance officer may not necessarily come from a reg background. They may come from a legal background or vice versa. But because the scope of the actual role itself has expanded, it requires a lot more. So again, that's an additional cost associated with the business. And then that kind of rolls into talent more specifically. I think as we've seen the emergence of the pod shops in the industry, who have been very good at acquiring talent from existing hedge fund managers and now from banks as well, that also has its own issues in terms of the cost of staffing. They are putting forward some pretty decent packages to acquire talent. If I then go into the issues for the asset manager themselves, from the manager's perspective, staff retention is difficult now. Staff members are expecting higher salaries, maybe larger bonuses to keep them going. I'm not going to lie, with the introduction of the pass-through fee, what we're now seeing as well is we're seeing existing allocators paying for other investors' prior performance through compensation. We also see an issue there in the aspects of style drift as well. If we're seeing a high churn rate of staff turnover, that's a lot of your ideas going out of the window. We have seen it where we've seen a number two leave the firm. And as a result of that, performance has taken a bit of a hit, and we've come to realize that actually they were quite an integral part of the business. I think, the regulatory and compliance focus has really meant that there's an added cost burden. Operationally, things are a lot more complex than they used to be. And then on the other side of that, you've got the rising cost of talent and retaining those talent. I mean, we can go into those in much more detail further in, but yeah, for me, those are the two biggest trends that are affecting our industry.
When it really comes down to it, right, in any industry, high performance teams drive the business, right? So that the talent aspect that you're talking about here is just monumental, right? If you're losing core people inside of all the management firms that you're working with, you've developed trust, you developed a relationship, they have a profile, you know what you can expect, right? And if all of a sudden it starts to drift, and then performance starts to drift, then all of a sudden where you had reliable partners, you're having to spend a lot of time with them that you haven't in the past. You're needing to look for new asset managers that you haven't had to, just to keep up with the performance that you had before, let alone look for new creative asset classes and new creative ways that you're going to grow the business, right? It's taking you backwards and not as much forwards in terms of being proactive in the business, right? So now leads to this idea, right, of internal versus external teams and investment management teams. Given everything that you've said there and the ramifications on the business, why are we looking to build some of these internal investment teams? Is it a buffer against the dynamics that you just went through? What's the reasoning behind that?
Yeah, absolutely. I mean, I think the way to look at our internal manager program is actually it's a siloed business separate to our external fund allocation business. So for us, it's a business diversifier, ultimately. The fund-to-fund business as it stands at the moment is still the cash cow of the business. Going back to my point earlier on costs, once you start to develop an internal manager platform, actually it's quite scalable. So as that grows over time, as you add more managers to the platform, obviously you benefit from those economies of scale. Now, where we have done it slightly differently to the pod shop, whereas what we're doing is we're onboarding teams who have an existing track record, but maybe haven't been able to raise assets for any given reason. So we're not just offering the operational infrastructure, but also the ability to help grow that manager out. The reasons they're not being able to grow capital could be a number of reasons. I think one of the things that we've seen, just me with my ODD hat on here, is just that one of the biggest issues in the post-COVID world was maintaining a company culture. We've got people who have been working from home. They're not homogenous teams as such anymore. And as a result of that, one of the benefits of having internal managers that are under the roof and they're being given guidance by the likes of us is that actually we can help shape that culture, or we can even take them away from maybe an associated culture with a prior firm. There is definitely that benefit from the internal manager platform. I think also as well, what we can offer is a different approach to risk management as well, because we've come from a pedigree of looking at external fund management. So we know what allocators are looking for from a risk perspective as well. So that helps. As I said, we are two separate parts of the business. We are siloed. So we have our Chinese walls in the office, literally. Starting an asset management firm or a hedge fund is incredibly expensive. Going back to the work that we've done with seeding, you have to have deep pockets. It might not always turn out that your growth trajectory is what you expected. So by having a larger entity help on that internal manager side, we're alleviating a lot of those costs. Now, there are downsides for the investment management team that are doing that. Obviously, there is a cost associated that we would take back from that. That may be a portion of the management and performance fees, for example. But ultimately, look, running a hedge fund isn't for everyone, or an asset management firm, a management company. Why don't we just let the investment teams do what they do well? And that's run their investment theses, not be overly heavily risk managed, but within a respectable set of guidelines, and grow that business that way. So that's more on the internal manager side. I would say on the external manager side, you alluded to it earlier as well, is that there is an element of trust. Yeah, you'll hear the old ODD saying is that our role in the industry is to trust but verify. But over time, we do build up those long-term relationships. We are a relationship-based business as well. So that trust element is very important. That's something we're able to do quite well with external managers. And at that point, information flow then becomes key. So as long as we can keep a good open dialogue with those external managers, for example, if an operational hiccup were to happen, that dialogue is actually quite important. So I would say that there's the relationship aspect of looking at external fund management. Obviously, we're constantly looking at the macro outlook. We're drilling down, we're then breaking it down by asset classes, by sectors, and so on. And we actually sometimes require quite niche strategies to diversify our portfolios. Now, that's something that's much harder to do from an internal perspective and much easier to find externally. So as a result of that, I think there's a lot of demand at the moment from our investors and just generally investors across the fund of fund universe that are looking for more niche opportunities. Now, we have the skill set to provide that on the investment due diligence side, on the operational due diligence side. So that really does add it as an added benefit for the external fund management, I would say.
You said a number of important things, and so I'm trying to remember all the things I want to follow up on. One thing in that you said is this idea of trust and this relationship, and then you said that comes down to a lot of the information flow back and forth, right? And you have to do things right with all of your managers. You send out DDQs, right? You send out these big surveys to make sure that we're still on track, right?
Yep.
And the information flow there, just getting that information, sending it out, having it filled out in a timely basis, having it come back piecemeal over email, right? In a big PDF document, in a big spreadsheet here, this way, that way, from here over here. That information flow, one might say, is on a dirt road versus like a super lane, it's like a lane highway, right? Just on a scale of 1 to 10, because I love to ask these kind of questions. How important is that information flow back and forth between you and your managers? 1, it's not important at all. 10, it's vital. It's vital to the relationship, right?
It is vital to the relationship. You will see with managers that they may be really forthcoming with information at the beginning because they're keen to get you in as an allocation to their fund. And then that might dip off over time. And that kind of hubris actually gives you an idea of the attitude of that manager. We've seen it before where we've seen information flows deteriorate over time. I'm not saying it's correlated to performance, but it's a good indicator of, again, going back to that culture point, going back to the attitude of treating investors fairly. I would say actually it's incredibly important to gain that information. Now, the problem is we're getting a lot more requests from our investor base, and which then obviously puts the burden on us to ask our managers for more information as well. I think the industry's done very well in looking at different tech solutions for that, that create substantial audit trails for information flow, which has definitely benefited the operational due diligence committee most. So I'd say slightly different for the investment due diligence committee on the basis that they are in constant dialogue. Our team speaks to managers on the monthly basis. ODD was slightly longer time period. So actually, if something does go wrong, we'd like to know sooner rather than later, as opposed to having to find out either by the grapevine, because we're a very small community out there, or it's become a regulatory issue, for example. And again, that lack of information flow has led us to veto managers where we've not gained comfort that they've been completely transparent with us. And I think when we talk about trust, when we talk about information flow, it's the transparency that we're really looking for. And again, yeah, as I said, those relationships build over time as well.
The idea here, right, of that you're getting requests for more information. So therefore, the need for not only your own due diligence, but due diligence to satisfy your client base really is doing nothing but growing, right? And
Correct.
the changes in the compliance community is requiring more information. The turnover issue is requiring the need for more information flow. Like everywhere you point and you think, it's requiring the flow of more information, which makes sense, right? We're in the digital transformation economy. The business of today and the business of tomorrow is going to be about the flow of information. I love the fact that we're trying to unbundle this a little bit because I want to ask, what is the difference between that flow of information in an external investment management partner versus your internal team, right? The ability to get that information on a regular basis. What are the pros and cons of just that information flow, internal, external?
Talking about our internal manager business, obviously it's real-time data flow, right? Because it's feeding into our risk management system. That then feeds into a dialogue with our sales team, for example, as well. Do we need to communicate anything to investors in those underlying products? What is the sensitivity of that information? My example earlier about regulatory investigations, a lot can't be disclosed, or lawyers will at least advise that a lot can't be disclosed. But again, even if that is the case, that communication of saying what can and can't be divulged, again, is a good signifier that they're on top of it as well. It is a lot easier for internal manager platforms because of that direct and real-time information flow. Less so, I would say, with external management, because obviously, as I mentioned, we're not in everyday dialogue with our managers. That really is the true difference between them, I would say.
So you said earlier, and a number of times, right? The bread and butter of the business, the fund to fund, right? Where nobody's saying we're trying to get away from external investment management firms, right? But how do we work with them better if this trusted relationship is really based on a need for a constant flow, not yearly DDQs, not, quarterly,
Yeah.
literally constant flow of information, right? And to a certain extent, it can be the bane of the business for an investment management firm, right? How much time are they spending fulfilling all these information requests versus being proactive in their business? How do we balance that?
I think there are some easy wins, right? External managers will be using a lot of third-party service providers that have this information to hand. So leveraging off that, I think, is very important. I can gain a basic understanding, for example, of information to do with the fund by reading an administrator transparency report. So is that readily available to investors? Do I get that straight from the administrator, which is an independent source, as opposed to badgering the manager for it every month or every quarter? There's already a lot of information out there that is a case of just forwarding on an email. I think the problem is from an allocator's perspective as well. We have to be better at asking for the right information, not just lots of information. So I don't think the onus as such is on the external manager. I think a lot of it is on us as allocators as well, because otherwise it is time consuming. So again, there needs to be a balance there. And that's where the relationship falls on us as well. So there is that balance in that regard.
It reminds me of a quote. I think it was from Mark Twain. And he said, I didn't have a time to write you a short letter, so I wrote you a long one instead. It's easier just to ask for everything. And I appreciate that. Like some of the responsibility is on us, right? We've got to actually do a better job and help facilitate that flow of information from our perspective as well. I think that makes a lot of sense. So where is this all going? When we think about the key trends and what's happening in the evolution in the industry, where do you see this going, and how does it impact how you're operating with your asset managers today?
Sure thing. So we take a couple of key factors and trends that have been going on, I would say, over the last few years. Again, I hate to come back to the awful event that was COVID, but what we did see over the COVID period is we saw the actual number of funds within the ecosystem reduce. Now, what does that mean? A lot of that was emerging managers that obviously couldn't go out and pitch for allocators capital because it was very restrictive in doing so. But at the same time, what it did allow is it allowed a consolidation into some of the larger hedge fund managers in the industry. So what that then led to is, and this is possibly a bit of a bugbear, I would say, across the allocator industry, is we're seeing liquidity terms change. What we're seeing is actually we're seeing liquidity terms become more illiquid. It could be going from a monthly to quarterly redemption cycle. We start to see the impact of investor level gates. And that's because there have been fewer managers in the ecosystem, at least partly so, which obviously becomes an issue for allocators, because if we're trying to be more proactive in terms of our allocation process, it actually becomes a negative in that regard because it's harder for us to be able to move capital appropriately. Now, there are a couple of solutions to that. For example, there are other fund structures that are more liquid. You could, for example, if you're looking at an offshore hedge fund and you decide actually you need that liquidity, you might look at a UCITS product, a 40 Act, for example, just to gain that additional liquidity. Now, the downside to that is, of course, that generally these fund structures tend to be geared with higher fees, higher rates of fees, so their TERs are generally higher. The AUM of the fund is actually smaller as well, so that generally tends to have an impact on the TER due to a function of size. Performance generally, because of the particular investment restrictions from a regulatory focus as well, that could also impact performance. So actually, it's not an overly efficient way of managing capital by looking at alternative, more liquid fund structures. So what we have seen, obviously the introduction of segregated managed accounts, that has the benefit of, from a treasury perspective, actually managing capital and much more appropriately, being able to lever up as well. That actually gives external managers a lot more scope and good information flow as well, going back to our previous points. But what I have seen, which is quite interesting, because actually for the new startup, for the emerging manager, actually the SMA route hasn't been a bad start for setting up your firm. There are lots of platforms out there that are offering segregated managed accounts, and allocators are doing so via SMAs. And what that allows is actually that takes a lot of the operational burden from the manager. There are still operational costs, but there are fewer on day one. You're getting your fee revenue coming in. You have fewer operational burdens. But over time, what you are able then to do is build out a track record so you can start marketing a future product. But it also allows you to scale up your business in time as well in preparation for that launch. So be that increasing your operational functionality, adding additional hires such as maybe as a CFO or a CCO. When we look at startups, we very much see the COO wears many, many hats. The development of SMAs hasn't necessarily been a bad thing, but a lot of internal managers, I think if you spoke about SMAs 5 or 6 years ago, it's quite a taboo subject. Allocators didn't like SMA or managers having SMAs due to the difference in liquidity rights, information rights. But that's changed over time. And what we've seen is we've seen a normalization of those SMAs in line with what have become future like offshore products.
If I could summarize what you just said, there's a major trend towards I want more liquidity than less, which makes perfect sense, right?
Yep.
Which means there's got to be a more creative exploration of how do we provide the liquidity but still get our returns, which means that we have to have more and more specialists looking at alternatives, right? And we're requiring that specialty of our asset managers. And they're looking at that and they're saying, hey, SMAs is one of the routes that we're going to provide this. Is that a good overall take on what you're saying here?
I would say that's a good overview. I think the only caveat that I would make when I was referring to those liquidity terms being harsher, I think what I should really focus on more, just to add a bit of extra color to that, is that the liquidity terms aren't matching up to the asset classes the fund is trading, I should say. That's actually quite an important point to make. So that's where the niggling comes in. The liquidity terms of the fund don't match up to the liquidity of the asset class.
Gotcha.
So just as a small nuance.
One of the things I'd love to ask you, Matt, is just in your career, what's something that you're just really proud of that you've been able to accomplish?
It's a pretty easy one, to be honest. As I reflect on the industry and working in the industry, especially working with emerging managers as well, is there are a great breed of people in this industry that have that entrepreneurial spirit, that are problem solvers effectively. And those relationships have been the best relationships to forge over time. I've happily worked with emerging managers to find solutions to their problems, even be a sounding board to some of them at times, because it's not an easy process to grow as part of that early start of the business cycle. So I'm most proud of our industry, the people I work with, and being able to be a part of helping them develop.
We've covered a lot of territory on this podcast, and our poor human brains can only retain a little bit of information at a time. If you said there was one important takeaway that you wanted the audience to have from tuning into this podcast, what would that be?
I'd say as we go into a more normalized world versus where we were back in 2020, firms are requiring to establish a better culture. That feeds into staff retention, a culture that then breeds relationships with allocators.
My big takeaway from this is we are still very much a relationship-based business, right? And we rely on each other and the trust of those relationships to perform. The requirements sometimes change, right? There's compliance issues that come in and make changes. There's liquidity pressures that make changes. But in the end, we have to trust on the relationships that we've established. to handle
Yeah.
those changes and grow and work together as a single team. And so I love that as a takeaway. Here's one thing that I know is going to happen. People are going to have questions. Would it be
Sure thing. Yep.
appropriate that I gave maybe a link to your LinkedIn profile that if people had questions, they could reach out to you?
Yeah, of course. Absolutely.
Matt, thank you so much for sharing. You've basically helped build the relationship, right? You've been a point of information that's the rising tide that lifts all boats. And I just appreciate all your insights and learning that we can take and then share with your peers in the industry.
It's great. Thank you, Steve. It's been a pleasure.